Hey everyone, welcome back to Corporate Decoder, the place where we unravel the stories hidden inside financial reports. This week we're digging into D Group Inc.'s latest quarterly filing. And let's just say it is a journey with more ups and downs than a roller coaster in a ghost town. Our story begins at the end of 2025 with D Group Inc. filing their quarterly report. Think of it as a checkup to see how the company is doing financially over the last 3 months. They've got these big financial tables, and that is where the real juicy details are. Let's dive into their balance sheet. On the 31st of December 2025, their total assets were around $58.9 million, which is a slight dip from about $60 million at the end of September 2025. This means the company has a little less in terms of what it owns. When we look at their liabilities, meaning what they owe, their total current liabilities were $5.5 million at the end of December 2025, down from $7.7 million in September. This is good news, as it shows they've managed to pay down some of their short-term debts. Now for the shareholders' equity part, this is basically what is left over for the owners after all debts are paid. They had about $50 million in shareholders' equity at the end of December 2025, very similar to the $50 million in September. This shows stability for the owner's stake. Moving over to the income statement, let's see how they did in the last 3 months of 2025 compared to the same period in 2024. Their total net revenues were $20.5 million in the last 3 months of 2025. That is a pretty significant drop from $24 million in the same period of 2024. Imagine losing about $1 out of every $6 they used to make. That is the kind of impact we're seeing here. A big chunk of this decrease came from their contract staffing services, which brought in $17.8 million this time around, compared to $21.5 million last year. That's a drop of about 17%. It's like a major client just walked out the door. On a brighter note, their direct hire placement services actually saw a small increase, going from $2.5 million to $2.7 million. It is not enough to make up for the losses elsewhere, but it is a step in the right direction. Their gross profit, which is what is left after paying for the direct costs of providing services, also went down from $7.9 million in 2024 to $7.4 million in 2025. However, and this is interesting, their gross profit margin actually improved. For the 3 months ending the 31st of December 2025, their combined gross profit margin was 36.1%, up from 33.0% in 2024. This means they're keeping a larger piece of every dollar they earn after paying for direct costs. This improvement is partly due to a better mix of services, with those high margin direct hire services making up a larger portion of their business. However, their selling, general and administrative expenses, which include things like salaries for corporate staff and marketing costs, were $7.7 million in 2025 compared to $8.4 million in 2024. So, they did manage to cut down on these costs. All these changes led to a loss from operations of $409,000 in late 2025, which is better than the $773,000 loss from operations in late 2024. So they are losing less money. And when you look at the final line, the consolidated net loss, it was $150,000 in late 2025, a significant improvement from a $692,000 loss in late 2024. They are still losing a bit of money, but much, much less. A significant event this period was the acquisition of Hornet Staffing Inc. On the 3rd of January 2025. They paid $1.5 million for this company, which provides staffing solutions in information technology and other professional areas. This acquisition is expected to help them compete better, especially with larger clients who use complex systems to manage their staffing needs. They also evaluate their goodwill regularly. Goodwill is like an intangible value of a company that is not on the balance sheet, often from past acquisitions. They assessed it in September 2025 and found no major issues, but they are cautious, noting that if market conditions worsen, they could see an impairment, meaning they might have to write down that value. Now, every company has to put in a cautionary statement about looking into the future. G Group Inc. is no different. They list a bunch of risks like economic uncertainties, the ongoing impact of the pandemic, competition, and cyber risks. It is basically them saying, hey, things could go wrong, and we're not promising anything for the future. It is a standard part of these reports, but it's good to remember. So how are we looking at G Group Inc. based on this report? On one hand, they show resilience, they've managed to reduce operating losses and seemingly cut down on some expenses, which is impressive given the tough economic climate. The improved gross profit margin is a positive sign, indicating they're becoming more efficient in how they operate and manage their costs. The acquisition of Hornet Staffing also offers a potential avenue for growth and access to larger clients. However, there are clear challenges. The significant drop in net revenues is a major concern. Losing a large account and the broader economic downturn are weighing heavily on their top line. While they're growing their direct hire business, it is not enough to offset the decline in contract staffing. The fact that they are still reporting net losses, even if smaller, shows that profitability remains a work in progress. They are very much a smaller reporting company, and that brings its own set of risks and limitations. The company is also watching the impact of artificial intelligence closely. They see it as both a potential disruptor and an opportunity to focus on new talent areas like AI specialists. This shows they are trying to adapt, which is crucial in the ever-changing staffing industry. Looking ahead, their ability to win back lost revenue, integrate Hornet effectively, and navigate economic uncertainties will be key. The company is in a restructuring phase, exiting its industrial segment and doubling down on professional staffing. It's a strategy that could pay off if market conditions improve and they can leverage their new acquisitions and AI focus. For now, it is a company fighting its way back to consistent profitability in a challenging landscape. Alright, that is our breakdown of Gear Group's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments, and if this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate world. Don't forget to check out our Discord community, linked in the description below for more discussions and insights. Thanks for watching, see you next time.